Uh, Welcome back. Um, so now um, we need to talk about bond indentures. Moving on to uh, the new. No, it's not the new topic. We're still continuing on with uh, the the default risk of the bond. So interesting thing is. Uh, Apart from aside to bond rating, right? Um, the but basically, how do you know which bond is rated what, and how do you know uh, what is the coupon rate on this bond, or how do you know what's the maturity? Of course, everything is uh, specified in the bond indenture. So bond indenture is like the agreement, like everything, or covenant, right? Uh, so everything is detailed in the indenture. Something similar to indenture in stock is called prospectus, right? So indenture defines the contract between issuer and the holder, and sometimes uh, there will be a sinking fund clause in the indenture. And actually, sinking fund, this can be good or this can be bad, depending on the context. And what's a sinking fund? Uh, Sinking fund is another name for future value of annuity. Okay, future value, and you must know what future value. You have taken all finance 100, so I'm not going to go over that again. But why is it called a sinking fund? Because it's like suppose you have a uh, think about a wishing well or a fountain, right? And famous fountains, like Trevi, Fontana Trevi in Rome, Italy. Why is the wishing well? Because they're making their wish, and as they make their wish, they throw coins. Think about it. You have um, a jar, filled with water, and it looks like suppose that's the wishing well. You throw a coin. If you throw a coin, every time you throw a coin, what's going to happen? It's going to uh, the first coin sinks to the bottom. Next coin will sink right up right upon the first coin at the bottom. The third one will be on top of the second, and so on. In other words, it will accumulate, right? And in case of coin in the wishing well, it doesn't earn interest. But if every deposit of coin earns interest, then what is that? That's annuity, right? At the end, there will be you know uh, with interest every time, right? There will be a lot. Future value will be greater than the sum of just the uh, sum of the principals or the payments, right? So that's why it's called sinking fund. But why do they why is it brought up here? First of all, think about it. Uh, the sinking fund it can increase the credit rating. It can raise the credit rating uh, of the bond. In other words, it lowers the default risk of the bond. Why? Suppose company A issued, $10 billion worth of bonds. 10 billion. $10 billion is a lot of money. And let's say this is a 10-year bond. How do you think they will pay back at maturity, when 10 years are up at maturity? How do you think they will come up with $10 billion? Of course, in principle, we would hope, in principle, that they will make good profit every year, so that at least they can accumulate. They can set aside $1 billion every year, and 10 years later, then you'll have $10 billion, and you will meet the payment obligation. No, but that is just a very naive thinking. Yeah, in principle, that would be a nice thing, but in reality, that's not what happens. In reality, what happens is they simply roll over, right? And also, we discussed this, in Finance 100. So think about it. 10 years are up. No matter how profitable the company is, coughing up 10 billion out of their, retained earnings. I mean, all the profits withheld in the company is retained earnings, right? They could have used it for investing in the growth of the company, or if the growth rate of the economy or in the stock market is greater than the growth rate of this company, then they would simply put it into the stock market and get a bigger return than from their own growth, right? But again, still, even if they have this 10 billion in their retained earnings, it's gonna it's gonna hurt them. I mean, it's gonna severely constrain their ability to invest either in their own growth. And if they have to take out 10 billion from that, that means they will have 10 billion less to invest in their own growth or to invest into the market, which may be able to earn 20% return a year. So they are reluctant to reach into their own pocket and pay out. So even if they have $10 billion, so what do? I mean, but think about it. If they can pay only 5% on their bond, right? And if they can earn on average 15% from the stock market, what would they do? They would rather put that 10 billion into the stock market rather than using it to pay off their bond, maturing bond, and rather borrow again from the market at 5%, borrow again from the bond market at 5%, $10 billion, and use that money to pay off the old bond that's maturing, to retire the bond, right? So, but then, if the company, what's the guarantee that this company will have $10 billion? I mean, if they are going to pay it out of their own pocket, where's the guarantee that this company will have $10 billion in 10 years? Especially if this company has very low credit rating, right? If they have a single B credit rating, they will. The investors will be very unwilling to buy their bonds. So what do? They will have to, they start a sinking fund. What does that mean? It may be difficult to come up with $10 billion in 10 years, They may not even have money to cough up. They may not even have $10 billion to cough up. If they were to do that, in a single shot, 10 years later, it's not going to be easy, and there's going to be no guarantee that they can do that. But instead, they start the sinking fund from today. What does that mean? If they start the sinking fund, that means they are making monthly. It may be difficult to cough up 10 billion in one at one time, 10 years later. But if you it's not that difficult to set aside $100,000 every month, or $50,000 every month, for 10 years. And then this is going to be an annuity. There will be 120 deposits of $50,000. And let's see, just quickly, right? Simply, 50,000 times 120. Of course, that's far from being, 10 billion, but the total of only the deposits would be only 6 million, right? But suppose if it is 6 billion, then they will have to put in another three zeros, another three zeros. So that's going to be 50. What did I say? 50,000 before. So another three zeros, then there will be 50 million. If they put in put into this sinking fund, 50 million every month for the next 10 years, it's going to grow to 50 million, 5 million. I'm sorry, 5 million, right? 5 million. Then it will come to 6 billion in 10 years. 6 billion. But with interest, that's only the sum of all the deposits only. But with interest, accruing every month, they may be able to reach 10 billion, right? We can work it out, using, future value of annuity formula. So then the investors can be seeing that this company is starting a sinking fund as they sell these bonds for $10 billion worth. Then the investors can be relieved. They can have some something to fall back on. So it raises the credit rating of the bond, or it lowers the default risk of this bond. So that's a good thing, isn't it, right? But I said it could be good or bad. Some bonds are retired periodically. What does that mean? It's a 10-year bond, and they sold, $10 billion worth of it. But periodically, every quarter, or the company's buying back, retiring certain, a fraction of that. I mean, if it is quarterly, there will be 40 quarters over 10 years, so 40 quarters, every quarter they retire 1/40th, right, of $10 billion, right? And they need money to retire periodically those bonds. So if they are starting a sinking fund, and the first one maturing in the first quarter, second one maturing in the second quarter, and so on, and the amount equals 1/40th of all the bonds sold, then you can you can reasonably expect, you can reasonably guess that this bond, uh, this issue of bonds, will be retired periodically. And of course, if you don't mind, let's say I get my, I collect my, because bonds are paying interest, semi-annually. Let's say I don't mind, if I get my interest, and then my bonds are, uh, you know, purchased back by the company. If they pay me the right price, I lose nothing. If you don't mind, that's fine. But some people want to hold, let's say this bond is paying 10% coupon interest, which is a very, very good coupon interest. And then uh, if your bond is um, recalled, of course, if this is a callable bond, then you will have to give it up. You will have to surrender. If it is not, if it's not callable bond, then they will have to pay you at least the market price to retire their bonds, right? As long as you get the market price or better, then you have no, you may not have any complaint. But parting with 10% coupon a year, um, you may not want to, right? If this bond wasn't paying, first of all, if this bond was a highly risky bond, uh, they must have paid, very good interest, coupon interest. Uh, but if this was very safe bond like AAA, they wouldn't have paid very high coupon rates. So you may not. And then if once again, if that is the case, the company wouldn't even want to retire because they can pay you very low interest and borrow money from you for 10 years. Why would they do? Why would they want? And you can, and they don't have to buy it from you if you are the original buyer. I mean, you can sell it to another person. There may have been, another, secondary market transaction between you and the next uh, bond holder, right? Next, the buyer who buys from you. So whoever is holding the bond, uh, if they want to uh, surrender the bond or relinquish the bond or sell the bond, and through the market, this company can repurchase the bond, right, and retire their planned portion of their debt. Now, so that's why sinking fund can be interpreted in two ways. And serial bond, of course, bonds come with serial numbers, but some bonds have, staggered maturity dates, right, for certain serial numbers. So in that case, as the bond matures sequentially, principal repayment burden for the firm is spread over time. Yes, they sell $10 billion worth of bonds over, let's say 10 years, and every year they retire like, 1/10, so $1 billion, and it goes by the serial numbers. Okay, so if your serial number, you are holding a bond, you're holding bonds with serial numbers that fall into the sequence that are getting retired in 2 years, right? Uh, and if you have been enjoying their high interest, coupon interest, you wouldn't like that, but you will have to. Now, so in that case, the burden of retiring, coughing up, $10 billion for this company is much lower. or even raising another 10 billion. I mean, 10 years later, who knows how the credit rating of this company will change? If the credit rating falls in 10 years, then the burden of borrowing 10 billion will go up because they will have to pay higher coupon rate. Make sense? So they want to spread this burden over, 10 years by retiring, only a certain portion of the serial numbers in sequence, right? In a certain, sequences. Now, but sometimes this is even done by lottery. So it's not exactly in the order of the serial numbers. Sometimes if your bonds are picked by lottery, then you have to sell. Now, serial bonds do not include call provisions or confront security holders with risk that bond may be called. In other words, do not include call provisions. In other words, they are not callable bonds, or they are not honest upfront that certain sequences will be called earlier than So the disadvantages: bonds of each maturity date are different bonds, so that lowers the liquidity of the issue. Now think about it: if you have the bonds that fall into the serial number sequences that are retired, early on, such a bond won't be very popular, right? So trading is more expensive. That means it costs you more, if you are holding this bond already, you cannot, you will have to sell at a lower price than similar bonds that are not serially to be serially retired. Okay. So this is an example of a sample of indenture. Now, and also in the bond indenture, there are subordination clauses. What are subordination? Subordination means there's a hierarchy, there's an order, there's a senior bond, junior bond. I mean, there's always hierarchy. There was a senior, there's a junior, right? Restriction. So subordination clause restricts. So subordination clause is a restriction on additional borrowing, stipulating senior bondholders paid first in the event of bankruptcy. Now think about it. Yeah. So Company X sold $10 billion worth of bonds, and I'm holding, at least $1 million worth of them, right? And as a bondholder, would you like this company to sell new bonds after you have already you're holding their bonds? You don't want that, right? Why? Because if they are selling another round of bonds, let's say you bought these bonds, last year, and 2 years later, like next year, they are selling new bonds. What does that mean? They're borrowing more money. $10 billion is already a burden to this company. If they are borrowing another $10 billion, what would you feel? As a lender, you feel uneasy because you feel the anxiety. Why? Because if your borrower if your borrower is borrowing more money, what's going to happen to the chances of your getting your money back? It goes down. Makes sense? The default risk goes up. They already have $10 billion worth of bonds, and if they have another 10 billion, then chances of getting your interest paid, coupon interest paid, goes down. And also chances of getting your principal back, the par value back, also goes down. This is the reason they don't want to do that. So they don't want the principal bond holders don't want any junior bonds to be sold. In other words, any new bonds to be sold. Okay, and in case of bankruptcy, the senior bonds are entitled to payment first, right? That goes. And dividend restrictions, the same idea. They don't want, as a lender, you don't want the borrower to pay out dividends to their stockholders before they pay you first. Make sense? Interest is, think about it, lender, the obligation, a borrower has the obligation to the lender first, right? The stockholders are owners, right? Stockholders are, in principle, owners. So owners get whatever is left, right? If you are the owner of a business, you have to pay your workers first. You have to pay your vendors first. You have to pay interest to the lenders first. You have to pay taxes to the government first. And then whatever is left, that's yours. That's called profit. That's called net profit, right? So dividend comes out of the net profit, or EAT, earnings after taxes, right? So dividends cannot go out, right, before they pay out to the bondholders. Protect bondholders by forcing the firm to retain assets rather than pay them out to stockholders, right? So after paying the interest, there's retained earnings, right? After paying out interest, then you pay out taxes, and you have net profit. And if they don't pay out dividends, the net profit is totally retained earnings. Now they want the retained earnings to be preserved for payment to the principal, payment of principal to the bondholders first, rather than paying out dividends. Okay. This allows payment of dividends if the sum of all the dividends paid since firm's inception is greater than sum of the retained earnings plus proceeds from the sale of stocks. Okay, collaterals. Usually, bond is a debenture. What's a debenture? Debenture is a debt that is not backed by specific collateral. Bond is strictly a debenture. In other words, it's based on the credit rating of the company. You don't hold, you don't risk, you don't require, you don't request collateral from the company to buy bonds. Make sense? This is the difference between the loan from the bank and the bond. Because if you want to get a loan from the bank, they will always ask for a collateral, right? Think about it. You want to buy a house, so you go to the bank and get what? A mortgage loan. But the minute you get a mortgage loan, they're not giving it to you for free. They want the collateral. What is the collateral? The house becomes the collateral automatically, right? It's not your house until you pay it off, right? You get a loan to buy a car. They're giving you a loan relatively easily. Why? Because there's a collateral already, right? The car becomes a collateral. It's self-collateralizing. If there's a physical asset like a car or real estate, right? These physical assets automatically become collateral. They are self-collateralizing, right? Makes sense? A bond is, but bond is a debenture, but some bonds, some bonds require collateral. Obviously, think about it. What kind of bonds require collateral? It's not the company that requires collateral. The borrower, I mean, the lender wants the collateral. Think about it. If a company has, very low credit rating, like, a triple C, single B, and of course you don't want to you don't want to raise your risk level by holding such low rated bonds. But, if you have to, what would you want? You want to require, you want to, you want, you will require collateral, right? So very low, high default risk firms will, in some cases, fine. They put up collateral. Okay. All righty. So the time is up. We're gonna continue in the next video. All right. Thanks for watching and stopping